This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So let's go through and look at another accounting standard. This one is employee benefits. It's IAS 19. Remember, you don't have to remember the accounting standard number, but if you so wish, you have it there. Okay. Employee benefits, what's it all about? Well, essentially, it looks at the accounting treatment of how a company remunerates its employees. Okay. Companies incentivize their employees, whether that's paying them wages, a salary, a bonus, healthcare provisions, could be a pension. This chapter goes through there and looks at all of that. I say all of that, there is a specific focus that we will see in a moment. So if you look at the three areas that the standard talks about, short-term benefits. Short-term benefits are essentially looking at how we account for wages, salaries, or bonus payments. And that's pretty straightforward, isn't it? That's going through there and looking at things on an accruals basis. Okay, so even if you haven't paid a wage, a salary, or a bonus in the month or in the year, you need to accrue for it because you have consumed the benefit that you get from employing that employee and therefore need to recognize an expense. Okay, long-term benefits are going through there and looking at the provision of healthcare. So maybe as part of your employment package, you are offered healthcare by the company free of charge. Maybe you have to pay a reduced amount. How do they go through and account for that? I'm not too worried about looking at how we account for that. I really don't think you're going to get much of a question, if any, on looking at that provision there for healthcare. The key one that you've got there is looking at your post-employment benefits. And the benefit you get post-employment is all about pensions. Okay, so that money that you get on retirement that you can then spend how you so wish and disappear off into the sunset and visit some of your favorite places in the world that maybe you thought you would never get to visit. Or it could be that you realize that you've got no money in your pension and therefore just have to sit at home and watch the television. Okay, so aware about looking at accounting for pensions. Okay, so when it goes through to look at pensions, that there are two types that you have, both very, very literal in terms of how it works and how it sounds. First one that you've got there is a defined contribution scheme. Okay, and that's whereby the pension that you receive from your company is a defined amount every single year or every single month. They contribute a fixed amount into your pension. So what happens at the end of every month, maybe the employer pays 5% of your basic salary into your individual pension pot. And the problem that you have there is that all this money goes into your pension pot. You pay a pensions advisor yourself to go through and invest it, hopefully wisely. If when you come to retirement, there's lots of money in the pension pot, great, you can enjoy that money. Okay. However, if there's a crash in the investments that you've made within your pension and the value of your pension pot has fallen, you can't go back and ask your employer for more cash. They have committed the amount that they paid over your working life, say 5% per month. Therefore, the risk lies with you. The risk lies with the employee with regards to the value of the money that you have when it comes to retirement. Okay. The accounting treatment is very, very, very straightforward. You just go through there and recognize an expense. Is it there in profit or loss? Essentially, you credit the bank, or if you haven't paid it, credit accruals and just debit your statement of profit or loss with 5% of whatever your salary should be. So that's ridiculously straightforward. I genuinely don't think that you get a numerical question upon it. I just think it's too easy. The hard of it, and it's hard to start off with, but it gets a bit easier as you practice the questions, is looking at your defined benefit scheme. Again, it's very literal. That's saying at the end of your pension scheme, the benefit that you get is defined by the business. Okay, so here what happens is the risk transfers from you, the employer, over to the company you have worked with being your employee, because they have defined the benefit that you get upon retirement. So they have guaranteed the return that you are going to get. So what happens is the company makes investments in their own company pension fund, hoping that the value of the pension fund will begin to increase. Okay. If when you get to retirement, there isn't enough money within that pension pot, the company needs to find it from somewhere. Now, where it finds it, it is beyond the scope of this syllabus, but just bear that in mind in the real world. There's been a lot of businesses that operated your defined benefit schemes. And when they've operated the defined benefit scheme, they may have gone bust. And there's not been enough money in the pension pot to pay the pensioners. So you've got a company that's gone bust. Where does the money come from? So, it does create some issues. However, as a pension scheme, it's fantastic. That's what you want. You want a benefit at the end of your working life that tells you an amount that you are going to get. Sounds good, doesn't it? But the problem is a lot of businesses are closing down the defined benefit schemes and beginning to move to defined contribution, because the businesses do not like to have that risk of running a defined benefit scheme. Okay. And that then begins to make the accounting treatment a little bit more complex, because if the company has the risk, the company needs to make the investments. So the company is going to invest within assets and shares. So it's going to have to recognize an asset on the SFP. And at the same time, over the employee's working life, the company is building up a liability, as they know that they owe that money that they are saving back to the pensioners on their retirement. So the first bit is pretty straightforward. If we go through there and look at the financial position, what you will be provided with within the exam is the fair value of the scheme assets, so the value of money that you invested in the stock market and wherever else it may be, say property, and the value of the scheme liabilities, so how much you owe the employees in however many years' time it comes to retirement. You net them off on the face of the statement of financial position, and you will either have a net pension asset or a net pension liability. Again, just be aware, if it's an asset, the positive number is referred to as a surplus. And if you have a net pension liability, that is a deficit. Okay. And in an ideal world, and we don't live in an ideal world, do we? Okay. Pretty damn good. Is that the asset should equal the value of the liability. Okay. So we can then liquidate the assets, pay off the liability when the employee begins to retire. Okay. Doesn't necessarily work like that, because the value of the liability at the bottom is just going to go up and up and up and up and up, isn't it? As we know, for every year that they work, we're going to have to make sure that there's more and more and more within that pension scheme. And then the value of the assets, the investments, what do? Yeah, they go up and they go down. So in good years, it's great. You're going to have nice big value of the assets that will hopefully cover the liabilities. But in some years, the value of the assets fall, and that makes the pension scheme then fall into deficit. And you've got a massive big pension liability, which has nothing to do with essentially your day-to-day operations and your trading, but it's to do with your pension. That's like an aside bit of your business, isn't it? Okay. If you're interested, which I'm sure you are, where do we go through there and get those numbers from? That's from an actuary. So you're training and studying to be a chartered management accountant, so a professionally qualified accountant. An actuary is a professionally qualified pensions valuer. Okay. And what they go through and do is that they provide you with the information, the value of the assets, the value of the liabilities. Just bear in mind bits and pieces that the actuary thinks about in terms of valuing the asset and valuing the liability. It looks at the level of the investment return, so what they expect you to generate, okay, on the investments that have been made for you. The number of leavers, because clearly the more people who leave, the less, if you like, that you need to accrue, because you're not going to have to pay the employee after they leave with regards to their pension. You've accrued enough up to their leaving date. They may have moved to another business. The number of new members, obviously, the more new members join, the more that we need to start to accrue on the liability. And then the number of people who die, a little bit morbid, isn't it? But, if people start to live longer, then we need to accrue more and we need to invest more, don't we? Okay, so that will change the estimates that the actuary provides us with. And that's the issue that we get. They are all estimates, or if you like, assumptions, guesses. Okay. And what you guess, or I say what the actuary guesses, isn't the same as what the actual figures are at the end of the year. Okay, so the actuary assesses all the figures at the start of the year. You account for those figures, and then the actuary comes back at the end of the year. And then what you've accounted for then is now different to what you then have at the end of the year. And what we talk about there are actuarial differences. But we've rephrased that now. It's being rebranded, and it's more referred to as a remeasurement component. I call them actuarial differences. It sort of didn't look good on the actuary if we have millions and billions of pounds worth of actuarial differences. Okay, so we call them remeasurement components to make life a bit easier for the actuary. Okay, they don't get any comeback from the pensioners or the users of the accounts when their estimates are quite wrong. Okay. We'll talk about where that remeasurement component goes in the following pages. You just got there. Is it there a little bit from the statement of profit or loss? So we can squeeze it all in there on the screen. So what goes through there through profit or loss? You've got two parts that you can record them in. You've got your operating costs and is it your financing costs? So operating costs are like your day-to-day expenses where you record your wages and salaries, aren't they? That's whereby you go through and record your current and past service cost. So if your employee goes through there and works 1 year longer, okay, then you owe them an additional year worth of pension. Okay, so what we're going to go through and do, the current service cost is an expense that you recognise as a result of employee service during the period. And then your past service cost is something that you may recognise in previous periods. So what companies tend to do is that if you've worked there for a particular length of time, maybe your benefit at the end of retirement becomes enhanced because of the number of years that you have worked there. So if that arises after 5 years, you recognise that past service cost at the end of the 5th year. You don't recognise bits of it over the 5 years. Okay. Key bit is that when you're looking at those service costs, you are going to debit your statement of profit or loss and credit the pension liability. Okay, you don't need to remember the debits and credits. You're already looking at me through the lens there. Just, Chris, what you're doing, don't write debits and credits. That makes it difficult. I think it does begin to help you understand that you're increasing the liability as you then increase the expense. Okay. Interest cost, what does that come to? That's, sounds nasty, doesn't it? It's the unwinding of the discount factor. Blech. Sounds horrible. Essentially, in simple speak between you and I, this is what the liability was at the start of the year, but we need to grow the liability up based upon interest, don't we? Okay, because that liability is going to be a lot more because the value of the liability is usually calculated by the actuary at the present value. So if we're 1 year on, we need to increase that value of the liability, taking account of the time value of money and unwinding it, if you like, compounding it up to its final or its terminal value. Okay, to work out the interest expense, you take the percentage given within the question, which is normally the interest rate on high quality corporate bonds or government bonds, and you multiply that by the value of the opening liability. So you take the liability at the start of the year and apply the percentage. Okay. Again, if you're looking at a journal entry, I apologise. But again, you debit the statement of profit or loss, increasing the expense and crediting the pension liability. Okay. The return on the investment, essentially that's the interest, the dividends that you receive from the investment that has been made in the company's pension pot. Okay, again, it's the expected return that we get. To work it out, you take a percentage and you multiply by your brought forward assets. Okay, so whatever the opening asset is, you apply the opening percentage to. Here, just be a little bit careful with regards to the debits and credits. you debit the pension asset, because if you've received interest, dividends, or maybe even capital growth, your asset value increases, and you credit your statement of profit or loss. If you like, they're increasing the income, whereby the debit previously increased the expense. Okay, excellent. Everybody happy with that so far? Yeah, don't worry so much about the debits and credits. You'll see in the example in the next video. Literally, all we do is we take a number, plug it in, take a number, plug it in, boom, it all falls out in the wash. Okay, so the debits and credits aren't so particularly necessary. The remeasurement components is either going to be a gain or going to be a loss. So it's a gain if it's a credit, it's a loss if it is a debit. Okay, so gains will be a credit, the other side of the entry must be a debit. So maybe that's an increase in an asset or a reduction in a liability. And if you have a loss, you debit your loss and you are crediting maybe crediting a liability, so increasing a liability, or crediting an asset, reducing an asset. But I think I've gone a bit too far already. Okay, let's just stop there. What we want to focus on is how to calculate it. Okay, how do we go through there and calculate this remeasurement gain or loss in other comprehensive income? Okay, so there's a standard pro forma, so make sure that you learn it. Okay, if you learn it, it'll make your life much easier. Okay, so what you do is you split it out into your assets and your liabilities. Okay, and what you do there is you start off with your opening assets and your opening liabilities. The return on investment that you calculated that went to the statement of profit or loss, and the interest that you calculated in your statement of profit or loss is recorded in the asset and liability respectively. Remember, the return on investment was an increase in the asset, wasn't it? As we debited the asset, credited profit or loss. And the interest there was an expense, wasn't it? So you debited the expense, credited, if you like, your liability. Okay. You can then go through there and see the service costs in your statement of profit or loss. So you increase the liability, as you see there, crediting it, and debit the expense. So all of those we have seen already. Okay. Remember, what we're trying to do is we're trying to look at the actual year-end liability and asset that the actuary has given us at the end of the year compared to what we've accounted for so far. Okay, to work out the difference. The contributions that are paid in. Okay, so you've paid money in, so your asset has gone up, hasn't it, as you've made an investment, and then you will have credited the bank. Okay, so they're your contributions you pay in. It's the investment that you make. Maybe your scheme isn't performing very well, so you need to put in some additional contributions, or maybe you just make regular pension contributions. Okay, key bit is there's no impact on profit or loss. It's just purely a statement of financial position adjustment as you reduce the bank balance and increase the pension asset balance. The one that students struggle with the most is the benefits that are then paid out, because that impacts both the asset and the liability, and is also in brackets. Okay, so there's a few things you need to remember. It goes in both assets and liabilities, and it is a reduction in both. So journal speak, you're debiting your pension liability because you're reducing the liability, and you're crediting your pension asset as you are reducing the asset. Okay, so debit liability, credit the asset. Why? Well, if the employee retires, you need to pay them, so you need to liquidate the asset, don't we? So if we liquidate the asset, that gives us the cash. We haven't made an entry to cash, and the reason why is because when we receive the cash, we then pay the cash out, don't we? Okay, and when we pay the cash out, we credit the cash and debit the liability, because if we've paid the cash, we don't need to include a liability anymore, as it has been paid off, hasn't it? Okay, there you go. Okay, so again, no adjustment is it there to your profit or loss. It's just, again, purely a reallocation between the assets and the liabilities. Okay. What you then do is you total up the assets, you total up the liabilities, you compare that to the closing figures. So remember, they are the closing figures that you have on the statement of financial position. So they are the figures given to you by the actuary when they return at the end of the year. And then what you do is you work out a balancing figure on the asset and a balancing figure on the liability. Okay. If we think about the assets, if you have an increase in the value of the assets, that's a good thing, isn't it? So that would be a gain. Okay. If your assets go down, that's not too good, is it? So a reduction in your asset would be a loss. Alternatively, you can think about it all debits and credits. If the assets have gone up, you debit the assets, credit the gain. If the assets have gone down, then you credit the asset, debit your loss. Okay. On the liability side, again, if you have an increase in a liability, it's a bad thing, isn't it? So that's a loss. And if your liability's gone down, that's a good thing, isn't it? And therefore a gain. Okay, remember, good things are gains, bad things are losses in the world of accountancy. If you want to go through and think about it in terms of debits and credits, increase in liability, credit liability, the other side is a debit as a loss. If there's a reduction in a liability, you debit the liability, don't we? The other side there, it is a credit and therefore a gain. Whoo! Net the two off, process it through other comprehensive income. It's the net figure that goes to OCI. Okay. Happy with that? Just go through, read it again, double check, triple check, and then what we'll do together is we'll go through and work out the example. So let's go through and have a look at the example, shall we? All about defined benefit schemes. See how we get on. So it says, as the requirement, calculate the amounts that will appear in the financial statements. So SFP, isn't it? Statements of profit or loss of Finland for the year ended 31st of December, is it there, 2015. Okay. So as expected, we have a defined benefit scheme, or if you like, final salary for all of its employees. The closing balance, so be careful, it does say the closing balance at December 2014. So that's the closing balance last year, which is essentially your opening balances this year, isn't it? Okay. We're 60 million for the assets and 64 million for the liability. So we're going to have to use that, aren't we, within our defined benefit scheme to work out the interest expense and return on assets. The actuary is given the following information that has yet to be accounted. That's where you come in, and myself included, for the year ended December 2015. Okay, so you've got your current and past service costs. So they're both going to go to the statement of profit or loss, aren't they? So we will need to adjust for those. You've got the benefits paid out and the contributions paid in. Okay, so we'll need to be careful with those. The assets and the liabilities are what appear on the SFP. So they are the closing figures. And then the yield on high quality corporate bonds. So that's the 5%, isn't it, that you will apply to the 60 million and the 64 million to work out the return on assets and the interest. So there's quite a lot to go through there and consider. It's important that you're happy with the pro formas. Okay, so let's start off first of all with the statement of financial position. Why? Because it's easy. Okay, you go through there, don't you? Take the fair value of the asset, which was quoted, was it, as 66. You then go through and look at the liabilities, which was, I think, 75. And what you have there is that 9. Okay. So you have there, is it your net liability? Okay. On the SFP, I'll keep it simple. We'll work it in millions, I suppose, and the rest, but we'll just go through there and work it in thousands, because tends to be a bit easier when you work in thousands later on. Okay. Yeah, get on with it. Nice and straightforward. So what you've then got is a statement of profit or loss, isn't it? So you've got there, is it your service costs? So is that your past and current? So current was 9 million, so we'll keep it in thousands. Past was 8, wasn't it? So is it 17,000? There we go. You'll see now in a moment why we then have changed it up, because you've got there, is it your interest expense? Is 5%, isn't it? 5% of the opening liability, which was 64 million. Make sure you get it the right way round. So that's 3,200, isn't it? And then what you have there is then your return on the assets, which is 5% of 60 million, which is there as 3 million, isn't it? Okay, I'll just make it a better 0 on that last one there. There we go, perfect. Everybody happy with those there? Again, I don't think that there's anything too distressing about that. You know, the key bit, isn't it, is that on the assets and the liabilities, you take the opening assets and liabilities, so they're brought forward, and also as well, you use the interest rate. Here we only had one, but you always use the opening interest rate. Okay, nothing that's provided at any other point in the year. Okay, happy with that? Yeah, excellent. What we'll need to put in as well in a moment is we'll need to think about your other comprehensive income, won't we? So to think about OCI, that's where you need to look at the remeasurement component, and is it the gains and losses? Okay. So what you've got is, I will just have 2 separate pages to look at the assets, and then I will also go through there and look at the liabilities. Okay. So what we've got, I'll just move that assets just up a bit more to give me some space. We start off with the brought forward opening assets, and the opening assets were there, weren't they, at 60 million. Again, we'll work it in round thousands. And the opening liability, wasn't it, I think was the 64 million. So again, in round thousands, 64,000, isn't it? You've then got the return on the interest. So the return on the assets was that there, I think, was 3,000. So that's the figure that you recorded in profit or loss. And on the liabilities, you have your interest, which I think was 3,200, if I remember correctly. Yes. You've then got your service cost, haven't we? Whilst we're there in the liabilities. So the service cost, you debited profit or loss, credited the pension liability. So there was the 9 million and the 8 million. That's 17, isn't it? If you don't believe me, it's that figure there, isn't it? As the 17. And then what I would begin to do now is deal with the cash consideration as part of the pension. Because what you've got there is you have, is it your contributions that you've paid in to the scheme. So the amount that you paid in was 5 million. So you credited the bank with 5, debited your pension assets with 5. Okay. Be careful with the next one, because the next one is the amount that you paid out, isn't it? That's the tricky one. When you paid out, what you do there is you liquidate the asset, don't we? So is that there as 6 million? And then at the same time, don't forget, you've reduced the asset and you also reduce the liability, because having paid the pensioner on retirement, they no longer owe the pensioner any money. Okay, so we reduce the asset because we no longer have an investment, and we reduce the liability because we no longer have an obligation. Okay, all good? Excellent. That's it. What we need to do now is actually work out the remeasurement component, don't we? So let's total up the value of the assets. Does that give me, is it 62? If I compare that to the fair value of the asset at the end of the year, is that there as 66 million? Okay, if you're curious as to where that came from, that's the closing asset figure that we've recorded on the SFP at year end, isn't it? So you've got 66 million. The balancing figure that you have, is it there as 4? So what you've got there is that is increasing the asset, isn't it? It's taking it from 62 up to 66. So an increase in an asset is a good thing, which is a gain. Okay. If you like journal entries, which some of you are going, Chris, don't be stupid. Of course I don't. Some of you going, yeah, I love journal entries. Then what you've got there is that you have debited your pension asset to increase it, and you credit your OCR, your other comprehensive income. Okay, so we have a $4 million gain. That's on the assets. What about the liabilities? Same treatment in terms of the liability. If we total up the liability, we have 64 plus 3.2 plus 17 less 6. I think that gives me, is it 78.2 million. You've got there as your closing figure, is that there then of 75. Again, if you're unsure where that 75 has come from, it's that fair value of the plan liabilities, isn't it? Or if you like, the closing figure there that we recorded on the SFP. Once we've got, is it the 75, you can balance it up. Now, I'll just be careful. We're going from 78,200 to 75,200. So a reduction of 3,200. Okay. Now that's a reduction in a liability. Reductions in liabilities are quite useful, aren't they? That's a good thing. So that is a gain. Again, if you're unsure, think journal entries. Okay, journal entries don't do any harm. Now what you've gone through and done there is that you have debited your pension liability because you have reduced it, and you credit your other comprehensive income. Okay, a credit to OCI is a gain, isn't it? Okay, so we have two gains. So what you have there is that if we're looking at what goes through OCI, then your remeasurement gain, is it the 4 million that you had on the assets, the 3.2 million on the liabilities, gives you $7.2 million, or 7,200,000. Okay, there you go. Questions? You could be asked to work out the total remeasurement gain. You could be asked to work out the remeasurement gain on the assets or the remeasurement gain on the liability, so not both. That would be a bit of a challenge, wouldn't it? Okay, trying to determine what figures you use on the asset and what you use on the liability. It could ask you as well, I suppose, back to profit or loss, it could ask you for the net expense on the statement of profit or loss. So that would require all three of those to be worked through, would that net expense be? Is it 17,200? Okay. Oof. Yeah, there's so much scope, isn't there, in terms of what they could ask you, but it's just a good idea to have a little bit of an idea what could potentially be there. If you found that a challenge, don't worry, you wouldn't be the first person to find it difficult, but what you find is that it's very formulaic. If you can learn the pro formas, know what numbers go there, I don't think there's much debits and credits to it. It's more about the number crunching. Okay, so practice a couple of questions in the revision kit, and then once you've done that, have a go at just what we cover in the next session, which is looking at your curtailment and the asset ceiling. You may get one question upon it. Okay, other than that, enjoy working through the questions, and I'll see you all in that next session.